Gold has been on quite the run over the past couple of weeks, coming up to its all-time high. That's why I figured it'd be a perfect opportunity to provide the best gold ETFs that trade on the Toronto Stock Exchange. There are several ways to play this, so stay tuned as I give you some ideas that may work for your portfolio, and stay tuned to the end where I'll be giving the way that I play this particular asset. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I definitely appreciate that. And don't forget, every single Sunday we drop a video just like this, so don't forget to come back to the channel and check it out. So our first stop is to take a look at gold's performance over the years. And we can see in this chart here, dating back to 2000, the thing that sticks out to me the most is the performance during the 08-09 financial crisis and the amount of people that were piling in to this asset class. And that is because gold is used as a hedge against any disaster or anything that's going wrong in the economy, which makes you think, why all of a sudden is it starting to rebound? Why all of a sudden are we heading back to the all-time highs? Well, that's because the economists and the analysts are predicting that 2023 we could be heading into an economic disaster, aka a recession. So that is yet to be determined. Today's video is working on how we can play this asset class in your portfolio. So what I did is I gathered all of the names that I was able to find on the Toronto Stock Exchange into an Excel spreadsheet here, listing the ticker name, the name of the fund, the stock price, what the dividend yield is, if there is any, the MER, how much it's going to cost you to own this particular ETF, and of course, what's the 1-year performance and the 1-year performance excluding the MER, taking that out of the equation and adding in the dividend. So what I mentioned at the beginning of the video is there is different ways that you can play this. So let's subsegment this video into the different categories of gold ETFs, starting with physical. These are ETFs that actually hold gold in a vault, and the way that this ETF benefits is that if the price of gold rises, then whatever they have in the vault will also rise as well. And it's a way that you can play this in a registered account like a TFSA or in an RRSP and not have to deal with the tax implications right away. And plus, we don't want to be lugging around gold bars in our house and having to buy a vault for it. So they take care of all of that for just a small management fee. So some of the tickers there are PHYS, you have VALT, and then you have KILO. And we can see just on a quick glance what their performance has been year to date. And we can see here that Sprott is definitely the winner in this scenario. Obviously, past performance is not an indicator of future performance. So let's just take a look further at the Sprott physical gold just to see if we can learn a little bit more. So we can see here 0.41 on the expense ratio, market price trading around 15. Let's read a little bit more of the benefits of holding this particular ETF. So it's created to invest and hold substantially all of its assets in physical gold bullion. We'll learn why that's important in a bit, but it provides a secure, convenient, and exchange traded investment alternative for investors who don't want to hold the physical gold and the inconvenience of carrying it around like we mentioned it before. What's interesting with this particular ETF is that if you ever want to pull your gold out of it, if you ever want to say, hey, listen, Sprott, I need the gold, you can actually redeem it on a monthly basis. And we can see here that you have the right to redeem for physical metals on a monthly basis. There's just a service fee or a delivery fee that's included in there. So that's one way to play it, where you want the fund to hold the actual physical metal. And we'll discuss now what the alternative is for that when you're playing the particular price of gold as a whole. And that is through what is considered to be paper gold, or companies that are building ETFs that are trading futures contracts of ETFs. So you're not holding anything physical. What they're doing is they're just buying the futures contracts, which is relatively the same, but doesn't give you that same protection that the physical gold ETFs would. And that is through the iShares Gold Bullion, Horizons, and Horizons has another product with yield, which is HGY. So when we look at the performance, we can see they're all relatively the same, around that 2 to 3% ratio. And the one that stands out to me the most is HUG. So let's take a look at the Horizons Gold ETF to see if we can learn a little bit more. So again, as we mentioned, as we look at the website, the performance is based on a futures contract. So they're looking at what the price of gold is going to trade in the future, and they're buying basically options on what that's going to be. It gives you no physical protection, and obviously there's a fee to hold it, and the performance isn't as good as holding on to the physical. So take a look at these, see if that's an opportunity for you in terms of what you're paying in the MER. But again, probably not my favorite when we take a look at all of them in consideration. The next subsegment, which is a super interesting way to play this, is actually through the miners, the companies that are out there digging in the dirt to get this metal out of the ground. And there is 2 ETFs that I found that you can play, which holds a bunch of these mining companies. We'll look at some of the names that they hold later, but we can see here the BMO and the iShares product, and this is consistent of multiple companies that operate around the world that pull this metal out of the ground. And the one that sticks out to me the most is the BMO product. And with this product, what you can see in these percentages is that it gives you a higher risk or a higher leverage play to the metal. So if you want to put a little bit more risk towards gold, you would play it through the miners. You could even additionally look for a junior miners ETF, which is super risky. So I'll just throw that out there. One of the better ways to play it if you want to increase your risk but not that much is through the BMO product, ZGD.to. Let's see if we can learn a little bit more about that. So again, BMO product trading for around $76, expense ratio 0.60, which isn't bad at all. Let's take a look at what this ETF is holding in terms of the companies that are incorporated there. So IM Gold, Torex, Harmony Gold, you have Eldorado Gold. So basically what they're doing is they're compiling all of the different gold companies and getting that higher levered play to get you a better turn when gold happens to be increasing in price. So those are 3 of the main ways that you can play it, whether it's the physical gold in a vault, whether it's the gold bullion, and then the other way to play it is through the miners. But I'll tell you an interesting way that I am playing this today. And as we go back to the Excel spreadsheet, we can see the bottom one that I've listed is the Horizons Gold Producer Equity Covered Call. And this one happens to pay me a pretty decent yield. You're looking at 10%. We'll learn a little bit as to how they're able to get that amount. And the performance, the year to date, has been 17%. That is, over the past year, it's provided a return of 17%, including the dividend. So let's take a look at the website here to see if we can learn a little bit more. This ETF gives you exposure to a portfolio of diversified North American listed gold producers, which is similar to the BMO product we just covered, but then it uses a covered call strategy to generate income. So here is the benefit. The benefit is that gold traditionally doesn't provide income. It sits in your portfolio and works like a commodity. So it only goes up when the price goes up. It's not like a business. It doesn't generate free cash flow. So where this ETF becomes super useful to me is that it uses option strategy to generate income, to generate yield. But the downside is that when gold increases in value, the options get called away, and essentially I cap out what my potential gain is going to be. I don't really benefit in the gain when the prices are going high. So this is something I may want to circle out of, especially if gold is strong and it goes past what its all-time high was. But what we're looking at right now is using it in the portfolio to hedge against a potential disaster in the economy, a potential recession, while generating income along the way. So hopefully that'll give you a high level idea of how this ETF is able to get such a high dividend yield, because most of them don't pay dividends because gold does not make an income. It's basically just a value, how much somebody is willing to pay for it next. But let's just take a high level look of what kind of companies that they're holding. This is the geographic area. Majority is in Canada. We could see Agnico Eagle, Franco Nevada, Barrick Gold. These are all high level blue chip companies, so you are protected on that side. So I like the fact that it's giving me an income, but I am aware that I am capping what my potential upside is, so you would be getting better returns on a capital gain basis if you held one of the others. I hope you enjoyed the video. I hope you got some value out of it. Please hit that subscribe button. I appreciate all of your support. We'll see what gold does over the next couple weeks, but I hope you have a great week in the market. Happy trading.